All right, we will go ahead and get started. For those of you that I haven't met, I am Nathan Davis. I am a partner of and the Chief Investment Officer for Aspen Wealth Management. I am in my seventh year with the company, and we started doing these quarterly market updates about 2 years ago. And after having had a few years under my belt of doing these quarterly presentations, I can very much say that it's a lot more fun to do these when markets are trending in the right direction and they're going up, as compared to what we experienced all of last year. And it does make it a little bit easier. It makes our jobs a little bit easier. It helps us breathe a little easier for all of our clients. And it's a lot easier to prepare a presentation when markets are up. I'll tell you, there's all this content out there when markets are up, though. So sometimes there's a little bit less to talk about when things are going well, other than just acknowledging that they're going well. And so for our presentation today, what we're going to focus on, we will look backwards a little bit, last quarter as well as year to date, of what equity markets, what fixed income markets have done to get us to this point where we are. We'll talk about the trends from the first quarter that persisted through the second quarter. We will talk about expectations for earnings for stocks or interest rate increases. We'll go through a little bit of an economic update that goes through trends for inflation, interest rates. We will talk about labor market dynamics and how all of this kind of fits together. And then lastly is our implication for investors. So if we spend time monitoring all of these things, what is the purpose of it? What do we gain from it? What do we do with that information? And we like to summarize that in our implications for investors, where, hey, what have markets done? What are they going to do? What has economic data been? What could it possibly be? And then how do we actually apply that to our management and our client portfolios? So we'll talk through those portfolio management considerations, as well as our, through 2024 shopping list of things that we're very much keeping an eye on. So I always like to start these off with a reminder of our investment philosophy, because overall we are not incredibly active investors. We monitor all this data. We keep an eye on how it evolves, how it changes, but it takes a lot of movements for us to change our portfolios and our allocations, and a lot of that comes back to this investment philosophy. We believe in a disciplined approach regardless of market conditions. If you are changing your investment strategies substantially as markets are selling off, chances are you do not have a disciplined approach, because the reason that you have a disciplined approach is to stay with your strategy through periods of market turmoil. So we want to be disciplined regardless of market conditions. We believe in a research-driven and grounded in academia process. So we want to look at data. We want to look at data from very long periods of time. We want to see how it's performed. We want to see how it's evolved. And we want to use that information to drive our asset allocation decisions, our trading decisions, our portfolio monitoring decisions. We believe in a globally diversified and cost-conscious portfolio. We want to own every public asset that is out there worldwide, and we want to do it in relatively cost-conscious ways, which means that a lot of our portfolio is in very low-cost index funds, where it gives us the ability to access, even if it's emerging markets, publicly traded debt, we can still access it in a very cheap way, where we're getting that global access, but we are not passing through a lot of cost to our investors in order to get it. Goals-based to engineer your portfolio's long-term success. So this one, and I'll jump on to our next one because they're very well intertwined, our dual risk mandate. We look at both willingness and ability to take risk when we're targeting a level of risk for a portfolio. These last two bullet points very much tie back to the fact that anyone that we're managing money for, we completed a comprehensive financial plan for them first. Everybody starts with the financial plan first. And so when we know what your goals are, we know how on track you are for your goals, what you need to accomplish from a savings perspective or from an expenses perspective. we're able to take all of that information from your financial plan and build out our investment policy statements that look at what kind of risk can you take, what kind of returns do we need to earn, what's the impact of inflation going to be, and we take these last two bullet points and tie it back for your portfolio's long-term success. So all of that to say, we will talk a lot about what markets have done. We'll make a few guesses on what markets may do or what the economy may do and what the outcome may be of those changes. But it doesn't change the fact that we still are very diversified and disciplined in our approach. We don't make changes to our strategies lightly. So starting that off, and for most of you, this will look familiar. This is a similar summary to what's included in our quarterly performance and billing reports. It really has just been a good start to the year. These numbers are very similar to what we saw in Q1. This is Q2 performance. The U.S. stock market, as reflected by the Russell 3000, the total U.S. stock market was up 8.39% for the quarter. Internationals were outperforming through the end of 2022 and for the beginning of 2023. The U.S. market has kind of started to steal back some of its dominance from internationals. Internationals were up just over 3%. Emerging markets and real estate are relatively flat. Particularly for real estate, that's a good thing. Real estate fell pretty hard and it fell pretty fast. And most sectors of it haven't seen the recovery that a lot of the broader U.S. stock market has. So being flat to a slight gain for global real estate is really just a positive. Bond market relatively flat, but down a little bit, whether it's in the U.S. or global. Global is actually up a little bit. Looking to a little bit of a further out lens, instead of just the second quarter, is looking at the last 12 months. And so thanks to the second quarter, the U.S. stock market, which is up almost 19%, just back to, getting back into that bull market territory, is now edging out international developed stocks, which are up just over 17% over the same time frame. And here's where we can see, some of the challenges that the rest of our asset classes have seen outside of our stocks. Emerging markets, so those developing countries, are still very much lagging and are still experiencing some challenges. Real estate is still down and hasn't recovered to the same extent that the rest of the U.S. stock market has. Bonds are down a little bit. There were times last year when we were looking at the bond performance over a 12-month perspective, and we were seeing 15, 16% down. So being down a little bit less than 1% after the interest that it pays is really a victory for the bond market, whether it be global, whether it be in the U.S. Looking out a little bit further, from a 5 years perspective, from a 10-year perspective, we very much believe that equity markets return over time. They definitely see volatility. And as we learned last year, the U.S. bond market sees volatility as well. It doesn't happen as often as the U.S. stock market does, but it does happen. But you very much are rewarded as an investor by staying invested in the stock market, whether it's good, whether it's bad. Particularly looking at the 5-year numbers for U.S. stocks at an 11.39% annualized return. So that's not cumulative. That's what it's earned on average every year for the last 5 years. Because that 5-year figure includes 2 bear markets. It includes a 33% slide during the onset of the pandemic. It includes a greater than 20% slide through most of the year in 2022. And even though, 2 bear market events in a 5-year period, we've still been able to see an annualized return of 11.4% in U.S. stocks. So just we'll talk about it a little bit more later in the presentation, but it's a good perspective for staying invested in the stock market, even when there is short-term volatility. Looking a little bit more specifically to equity markets. So at year to date, it's really been mega cap tech versus everything else. And I'll expand on that here a little bit. We talked last quarter in our presentation that there was very low volatility in equity markets to start the year. That very much persisted in the second quarter as well. There has been along with that mega cap tech versus everything else, a lot of that is a contribution from enthusiasm around AI, artificial intelligence, and the commercial expansion of AI and what it could mean for these companies. And then we'll touch a little bit on corporate earnings. Expectations for corporate earnings are pretty low. A lot of the sentiment going into are we going to be in a recession or are we not? But companies, for the most part, on average, are meeting or slightly topping the already low expectations they have for earnings. We'll touch on that a little bit here too. I always like using this just to keep things in perspective to give us, the last 25 years of ups and downs in the market, and what it means for investors. So these are inflection points in price earnings multiples. So we like to be mindful of when we have a price of what the market is today. How do we get to a price? Well, corporate earnings, as I mentioned, are an important part of that, because when we look at what the value of an asset is today, the future income or the future earnings that we can expect to receive from that asset is a large component of what the price is today. And then on top of that is a multiple of that revenue. And the things that go into the multiples of revenue are what our sentiment is, how rosy we feel about the future, something like AI expansion, and will that allow companies to be more profitable over time. And so keeping an eye on where we are now, the valuation on whether stocks are expensive or whether stocks are cheap, which is phrases you'll hear when you turn on CNBC to check in where the market is that we've very much seen some highs and lows in valuations over the last 3 years. We have gotten to the point where, even though at the start of the year, and particularly last year, things had sold off enough to the point where they were below averages. What we're looking at right now is that we're above average, but not too far out of the normal. When we're looking at these dotted lines to the high and to the low, as long as we stay within those one standard deviations, it's what could really be considered a normal market. What we want to be mindful of as earnings numbers continue to be released, as the value of the stock market as represented by the S&P 500 as it continues to grow. We just want to be mindful of the trade-off between how much are we paying for that future stream of income. As it stands right now, the price recovery that we've seen in the stock market is largely being driven by us as buyers and us as investors being willing to pay more and more of a multiple relative to the earnings that we're getting today and the earnings that we're expecting for the future, as opposed to an actual expansion in growth of earnings. And so we just want to be mindful of what does that mean for future expectations for price volatility, future expectations of returns. Right now, we're still very much within normal bounds. So talking to corporate earnings and sources of earnings growth, despite economic headwinds, markets have had a solid year so far. Part of that has been better than expected earnings, but as we mentioned, the expected earnings were already very low. If you have really low expectations for something and you still find a way to kind of just beat it out and just exceed it, that's not always a reason for true celebration. It just means that you didn't really expect very much of yourself. And so we can look at earnings reports for U.S. companies very much the same way right now. But we've had a pretty good earnings season, and expectations for the end of the Fed hiking interest rates, the end of that rate hiking cycle, have very much led to some price improvement and have led to some optimism. The earnings per share for S&P 500 companies has grown about 6% year over year, and a little over 4% of that was just since the fourth quarter of last year. So while we saw a little bit of a slow and a little bit of positive last year, we are seeing some improvement in corporate earnings. And then it's also important to look at what we see on the right-hand side of our screen here, is that profit margins for companies have risen to 11.7%. So indicating that companies have had success defending their margins, even in a inflationary environment, even in a rising rate environment. With recession risks looming going forward, these profit estimates, which we see represented by the blue bars on the left-hand side of our graph, we very much will see these come under further pressure as like true concurrent indicators for recession, as unemployment changes or anything like that. We'll start to see these earnings estimates come under a little bit of further pressure. So one thing that we want to be mindful of for performance this year is that, like I said, it's kind of mega tech versus everything else. As of the end of the second quarter, the top 10 companies in the S&P 500 accounted for 13.8% percentage return of the 14.9% return as of the end of the second quarter. Effectively, the 10 largest companies in the S&P 500 are contributing 93% of the total return to the index. And so when we talk about the price of companies growing and determining whether that's a function of earnings growing or if it's just a function of us or investors being willing to pay more for the same level of earnings, what we see on the left-hand side here is that even though the market overall is trending upwards in terms of its relative valuations, it's largely being driven by those top 10 stocks, whereas everything else, the other 490, relatively are much more in line with what an average would be for the overall market. It's important to note, we've gotten a few questions on it, just because the top 10 companies, which are largely tech companies, are contributing so much to return, they're allowing their valuation multiples to get higher and higher. It doesn't mean that this is a recap or a repeat of the 2000 .com tech bubble. To kind of provide a point for comparison, and you can see it a little bit on the chart on the left-hand side. But the price earnings multiple of the top 10 companies in the beginning of 2000 was about 43 times their earnings. Right now, they're at about 29 times their earnings. And the overall tech sector, so looking past just the top 10 and looking at the entire sector itself, the entire tech sector was valued at about 59 times earnings. And today, that is, the rest of the sector is in line with the top 10. It's at about 28 times earnings that we're paying from a multiples perspective. And so, is it maybe a little bit of irrational exuberance around those big 10 companies increasing in value, driving those returns? It's very possible, particularly tech companies. They're just considerably more volatile than the rest of the market. The highs and the lows occur a lot more frequently, particularly looking back over the last 3.5, 4 years, to include the run-up before the pandemic, the run-up after the pandemic. They tend to be more volatile. But overall, for us, we really like to look at the rest of the U.S. stock market, knowing that we very much have exposure to those top 10, those large companies. They do make up 31% of the S&P 500. But we're also mindful of what our true allocation is to them. And more often than not, we are underweight those companies relative to the overall benchmark. We do like to make sure we have exposure to the entire U.S. stock market. I mentioned that a theme that has persisted is that volatility is easing. And so we've had 2 days, which is shown on the left here, 2 days in calendar year 2023 that the S&P 500 traded at a plus or minus 2% day. Generally, if you keep an eye on what the market does on a daily basis, if the market's up 2.5% or if it's down 2.5%, those are very much outliers. That's what we would call a volatile day. Something happened, there was some sort of news, there was a big reaction that caused a lot of buying and selling. And so far year to date, we've had 2 days, and that is exactly the same number of 2% plus or minus days that we had at the end of the first quarter. So second quarter had no plus or minus 2% trading days in the S&P 500. Looking back at a few other periods in time where we've seen low volatility, from 11/8/16 to 2/1/18. So the most recent period that you see that was a pretty long stretch of no volatility, we went 310 days without a 2% trading day. And then from 2003 to 2006, like the post dot-com bubble burst, but pre-Great Financial Crisis, we actually went 680 days without a 2% trading day. And so tying that back to why does that matter? It does matter just for the sanity of investors, because I would say that last year, well, it was a tough year from start to finish from a returns perspective. It was all the intraday swings that I would say we received the most calls about or heard the most concerns about for investors, with just, why is the market up so much today when it was down so much the day before? Why is it down so much today after being down so much yesterday as well? But while the sanity of our investors is preserved a little bit when things are less volatile, on the right-hand side, we can see that for calendar year returns, if there were more than 10 plus or minus 2% trading days, the average return of those years was 0.3%. And if there were 10 or less plus or minus 2% trading days, the average calendar year return was 17.2%. That is in no way to say that, like, let's absolutely expect that by the end of 2023, we will have earned 17.2% in the market this year. But it is a good statistical indicator that when we see a lot of daily volatility, a lot of those big swings on any one given day, it tends to be negative. Those volatile days tend to be negative. And when we see very little volatility in daily trading, it tends to be the longer periods of just slowly marching upwards for positive returns. It's not as common that we see a slow, not volatile downward march in markets. Less volatile years tend to be a good thing for investors because they tend to be positive years in markets. And I do think that the market's getting ahead of itself a little bit with the AI enthusiasm, but it's just way too prevalent in all of the news media to not address it in some way, shape, or form. And so when I came across this, I thought it was interesting. So these are different very common services or apps that that we all know, that most of us use. Jim is very active on TikTok, but personally, I don't have one myself. But ChatGPT, it's very hard to do anything without hearing about how ChatGPT is going to change the world. We hear it all the time for how ChatGPT is going to change the financial advisory space. How is ChatGPT going to change, the copywriting space or writers, or is ChatGPT going to write all of the programs that we watch going forward and, leading to writer strikes? It only took 2 months for ChatGPT to reach 100 million users. Compare that to TikTok, which rose pretty fast as well. It took 9 months. But even something like Uber, which is pretty hard for any of us to avoid at least a few times a year, depending on the circumstance, took 70 months to reach 100 million users. So the adoption for the technology like this has been very quick. And when it comes down to these tech-related companies, looking at successful tech companies today relative to the very unsuccessful tech companies of the early 2000s, like Pet.com or AOL, just absolutely failing to convert the market share they had on internet users into anything sustainable in the long term. You first have to start with a user base. You have to start with adoption. And then at that point in time, it's just being able to convert all of those users, to convert that adoption to some form of revenue generation, whether it be ads, whether it be paid services. But I do think it's important to note, while a lot of the headlines talk about AI's impact of market returns so far year to date, the greatest beneficiaries of AI are going to be companies that haven't even been created yet. It's not likely that adoption of ChatGPT is going to 10x the stock price of Microsoft or Google. The greatest beneficiaries from an investment perspective are going to be companies that haven't even been created yet. We'll expand on that a little bit more in kind of our last section of implications for investors. And then it's also important to note that when we get to our section on just the economy as a whole, AI breakthroughs may lead to greater productivity, reduced costs. So it may allow all of us to keep our jobs and not necessarily get replaced by AI, but it could potentially help all of us do our jobs much better, leading to better productivity and efficiency. So all still remains to be seen. All right, from a fixed income markets perspective, interest rates continued to increase across all maturities. The yield curve inversion has steepened. Short-term rates have been higher than mid to long-term rates. And then the dynamics of the overall fixed income market remain attractive. Those are the three main talking points for what occurred in fixed income markets last year. Again, even kind of with equities, it was really hard to find something exciting to talk about fixed income markets last quarter, because it's very much the same as the first quarter. And overall, just summarizing it as things are much, much better than they were last year. So looking a little bit at where our rates are today, what expectations are for the future, how we got to where we are. Since the beginning of 2022, the Federal Reserve has hiked rates by 5%. And I do believe Jay Powell was starting, or they were announcing their raise at the exact same time I was starting this. And so I haven't checked into that yet. But the chairman, Jay Powell, is going to have a press conference here in about 30 minutes, if not starting right now, to set expectations for what they feel like the rest of the year, what 2024 may look like. But in June, they elected to pause their raising for the first time since they had started. A lot of it had to do with the fact that we were a little bit unsure if the U.S. was going to default on all of its debt obligations. We were going through a little bit of a debt ceiling debacle, as well as just for the fact that they had indicated that they were going to continue to slow the pace of raising rates. And skipping a raise every other meeting is just another way to continue to slow the pace at which they raise rates. What we're seeing now, that not necessarily from last quarter, but very much from the end of last year, that we are seeing that is different, is that market expectations are now more in line with what the Fed is saying they're going to do, the Fed's own expectations for what rates are going to look like going forward. Previously, the market had been pricing in, and by pricing in, most of that just comes down to like, well, what kind of yields are we getting on our bonds, and what is it costing us to buy our bonds, and how the two interact. But the market had been pricing in 3 rate cuts by the end of 2023, at the end of 2022, and And where we are today is that there's really not an expectation for that by year end. We see that market expectations, FOMC estimates or expectations are much more in line, where we're going to continue to raise rates slowly through the end of 2023. It's possible that we see rate cuts in 2024, but even if we do, it would be mid to late 2024. We don't want to build a fixed income portfolio around the expectations that they are going to raise rates one more time and then start cutting them and start reducing them before year end. The market and the Fed seem to very much be together and in line with their expectations. at some point next year, we may see a cut in rates, but to really not expect one prior to then. And so when I say that our yield curve is currently inverted, what a yield curve is, it just shows this is for US Treasuries. Given all of the various durations or all the various maturities of the bonds that the US Treasury issues, what are the corresponding rates for all of those maturities? And when a yield curve is inverted, it means that short-term rates are higher than mid to long-term rates. That is not the norm, which is why we get the phrase inverted, because it's opposite of what it's supposed to be. Traditionally, what you see on the bottom here is the end of 2021, it's the yield curve, is that the longer investors hold a bond, they want to be receiving a higher payment for that. Because they want to be compensated for effectively having their money locked up for longer periods of time. What an inverted yield curve like this could indicate is that investors have concerns about the mid to the long term, and that is why they're not putting their money there for now. Driving up all of the yields that we see on the short term. They just want that short term protection, but the yield curve has continued to steepen since the end of 2022, which meaning those short-term rates are continuing to get higher and higher relative to the mid and the long term. The 1-year T-bill, which you can see as effectively the first dot, increased by 76 basis points, which is 0.76%, 0.761%. The 2-year T-note increased 81 basis points to 4.87%. And then on the further down the curve, our 5-year Treasury notes only increased by about 0.5%. They rose to 4.13. 10-year Treasury notes only increased by 33 basis points to 3.81. And so we are seeing that the short-term rates, the short-term curve is continuing to invert further, which is really the one lagging, or I guess remaining indicator of the participants in the bond market having concerns about long-term productivity, long-term growth, long-term stock market returns, or anything like that. Even with the yield curve continuing to invert, there's a lot going on here, and we'll go through it. The scale of the dynamics of the fixed income market still remain very attractive. And so what we see on the left-hand side is January 1st, 2022, so the very beginning of last year, before the rate hikes really started kicking in. We have all of our maturities, like we just talked about, for treasuries as the first couple of rows. There's considerations for investment grade corporate bonds, there's municipals, there's all different types of bonds or fixed income investments here. When looking at if rates were to rise by 1%, how would that impact the return of all of these vehicles? And how that differs from the right-hand side and where the market is today is that the right-hand side has a what if rates rise 1% or fall 1%. And it's because on January 1st, 2022, there was effectively no room for rates to fall 1%. Rates were as low as they could have possibly been, with the United States always staying committed to never going to a negative interest rate environment. And so when we are looking at allocating our bond portfolio, at the beginning of 2022, it was saying, okay, if yields are 2%, the best we could absolutely hope for is 2%. But if rates start to rise, the left-hand side showed us what the expectations were for how bad things could get from a price perspective, using the 30-year Treasury as an indicator to say, hey, we could have earned about 2.5% off the yields on a 30-year Treasury, but if rates rose 1%, we would be losing 18. And so that's not a very good skew that we like to see as portfolio managers. We like to see either very similar, hey, what I could make and what I could lose are relatively similar amounts, Or we like to see positive skew, where what I could make is much higher than whatever it's possible I could lose. And so taking the context of January 1st, 2022, and applying it to where we are today, as you can see from a 2-year perspective, from a 5-year perspective, even if rates rise, which is bad for bond prices, rates could rise 1%, and we are providing positive returns no matter what in 2-year treasuries. The interest that they pay is high enough that you will earn more income than you will lose in price falling. So even if rates rise an additional 1%, investors are making money either way. Looking further and further out from a term perspective, the next row down is our 5-year treasuries. If rates were to fall 1%, you would earn 8.5% over the next year from price improvement and from the interest that you earn. If rates rose 1%, you would lose 0.2% or 20 basis points after you factor in the income that you earn and the price reduction in the asset that you own. So even just looking at the first 5 years of the US Treasury curve, that is the type of skew that we very much like to see, where it's in investors' favor. Looking, skipping over the 10-year and looking at the 30-year like we did for January 1st, 22, the 30-year Treasury has historically been a very effective hedge against stock market volatility. Last year was a huge exception to that because the stock market was falling at the exact same time that interest rates were rising. So it was not a great hedge last year. But historically, the 30-year Treasury has been an effective hedge against stock market volatility. If you were to buy 30-year Treasuries today, you could earn 21% if rates were to fall 1%, and you would run the risk of losing 13% if they continued to rise another 1%. And so that's where we see the amount that you could gain relative to the amount that you could lose continues to be more skewed in the fixed income market today, which gives us a lot of flexibility in creating our bond allocations for client portfolios, where we have some cushion. The interest that it is currently paying today gives us a lot of cushion against potential price volatility if rates were to continue to rise. Also adding in the last caveat of I would say it's very hard. It's very hard to think that rates rising 1% more and rates falling 1% have an equal outcome percentage. We are much more likely to see rates fall 1% over the next 12 months than we are to see rates rise an additional 1%. So just because we're illustrating a 1% rise versus a 1% fall here does not mean that they're equally likely possibilities. So turning things to just the broader economy, the economy is still holding up well. With that said, recession risks do remain. We'll touch on a few of kind of the main indicators that are indicating a recession is still very possible at some point in the time. Although I wish I had a better crystal ball to tell you exactly when it would be and what was going to cause it. We're starting to see some cracks emerge in the labor market, which is much more so from a big picture perspective, because tying that more so to the short term and just looking at unemployment itself, it's possible that we see unemployment start to rise, but we do overall still think that if it rises, it's only going to be slightly. And then inflation continues to fall. It's gradual. It has been slow, but effectively every month that they release inflation data, it's just a little bit better than it was the month before. So inflation continues to fall gradually. Looking at overall economic growth and components of the US GDP, so the economy remained resilient for the whole first half of 2023, not really even just last quarter, which theoretically widens the runway for a potential soft landing. A soft landing is a phrase that's been thrown out a lot by the financial news media, which would just imply that Yes, the economy was overheating a little bit, markets were very high, but the Federal Reserve launched into its rate hiking cycle with the intention of cooling the economy, attempting to avoid us, falling off of a cliff and having economic activity grind to a halt immediately as opposed to slowly. And a soft landing would imply that they raise their rates. It does cool things down, but we continue to grow and we avoid a recession altogether. It is, somehow technically still a possibility that we may not face down a true recession in the next year. Looking across each sector of the economy, tells us that momentum is still slowing, but business spending appears to be the most at risk. And this is where we just get into the speculation of what could be or if we will hit a recession or when. Whereas, right now we've seen some layoffs in the tech sector. In and of themselves, they're not too substantial, but it's possible that those layoffs could weigh on, research and development spending. It could weigh on some of those businesses' spendings and the investment. There's also currently an increased caution among lenders, as really a symptom of the banking turmoil that we saw earlier in the year, where it's a little bit more difficult for businesses to get cheap money that they can then put into growth and they can use to grow corporate profits or anything like that. And so capital expenditures are something that are really starting to come down a little bit. Also to keep in mind, so we never want to underestimate the American consumer's propensity to spend. Americans very much do just love spending money. As we are right now, from a personal savings rate perspective, it's fallen to 4.2%, and that is well below the long-term average of 8.9% of what Americans are saving. And so we do know that that savings number will need to increase again eventually. As savings increases, it does put a constraint on consumer spending. And then even things like, student loan payments. Student loan payments are set to resume and very well could put a strain on consumer spending in the coming months as well. As you can see on the right-hand side, consumption, whether it's business, whether it's personal, is a very, very large component of our GDP. So if it's harder and harder for people and for businesses to spend their money, it's going to start to strain our GDP eventually. So looking at the labor market more so structurally as opposed to just looking at unemployment, the labor market has been a bright spot of the economic expansion, but there's definitely cracks that are beginning to emerge. The economy continues to add jobs. You can see that on the top left here, the non-farm payrolls and how many jobs are being added every 3 months. But the improved labor force participation overall has supported growth, but it's the 25-year-old to 54-year-old demographic that has fully recovered to pre-pandemic levels. And you see that on the right-hand side with the light blue line of that 25 to 54-year-old demographic continuing quarter over quarter to participate more in the labor market. Where we structurally have an issue for the mid to long term is that the dark blue line is our baby boomer generation. It's 55 and over. There was a sharp drop off in their labor force participation during the pandemic, and they never, for the most part, really started going back to work. I like to think that we are very much part to blame for that because we're really good at financial planning and retirement planning, and nobody had to go back to work if they didn't want to. It's no secret that the baby boomer generation was very large and they saved up a lot of wealth and they're planning to transition in the future and all the things that go with it, where if you have those things, you likely don't have to work. But it is a structural change to the total workforce of the United States that very much changes things for the mid to long term, where when we look at unemployment today, we look at the jobs being added today, all of that is well and fine, but it very much limits us from being able to continue to grow that when the total amount of labor available to these companies is really just system-wide lower than it was previously, thanks to the baby boomer generation starting to retire. And so what that looks like is that a tight labor market has allowed unemployment rate to hover about a 50-year low. It's at currently right now 3.8%, and the average 50-year low is about 3.5%, which we just saw recently. The cooling labor conditions have contributed a little bit to a moderation in wages. So wages only increased 0.3% month over month in the month of June. Wage growth overall from a year-over-year perspective is down to 4.3%. The highest that we saw that wage growth recently was 5.9% on a year-over-year basis that we saw back in March of 2022. So the increases that workers are seeing in their wages is starting to come down a little bit. Doesn't change the fact that there's a limit to how much unemployment rate could rise given the structurally smaller labor force that we just mentioned above. So for the short term, probably a good thing that all the baby boomers exited the workforce, because for all of the workers that exist today, it does make it much easier for them to find positions and for there be more roles that need to be filled. It's more so the mid to long-term considerations that we are concerned about with that structural change to the labor force. Looking at CPI by component, looking at inflation, after nearly 2 years of very hot inflation, squeezing wallets of all consumers, a sustained downward trend is very much underway. Headline CPI peaked at 8.9% on a year-over-year basis last June, and has fallen to 3.1% year-over-year as of this June, so as of the end of last month. When we look at the different components of inflation, core inflation excludes energy and it excludes food prices, which can be more volatile on a month-to-month basis. So when we look at our core CPI, again, excludes energy, it excludes food. That still is at 4.9% year over year. The main issue for core CPI, and we talked a lot coming out of the pandemic of what parts of inflation were sticky and which ones were transitory, like which parts of inflation were going to go away once we got past the pandemic. The one area of our prices here in the US that has been very sticky and will continue to be sticky going forward is shelter. Shelter is 44% of the makeup of core CPI. It's come down a little bit, but it is still elevated and it's still going to remain high. And that is just based on the fact that we have a structural shortage of housing in the United States. It will be interesting to see that as rates remain high, it does disincentivize home builders, it disincentivizes multifamily apartment builders because it's more expensive for them to undergo those projects. And so the Fed really wants to get inflation down to 2%. Most areas of expenses are trending and working in the right direction to help them reach that goal. But it will be really interesting to see if, from a shelter perspective, if it's even possible to get inflation down that low when a large component of core inflation is structurally unable to moderate. We don't have enough homes, we don't have enough apartments. So tying it back to implications for investors of, hey, we keep an eye on what markets have done and what they could do, what economic data has been and what it could be, and how economic data in the future could impact markets in the future. And so from an implications for investors perspective, We'll go through what I consider, our investment committee's shopping list. We want to put an emphasis on putting cash to work. We want to evaluate the composition of our equity allocation. And then, as always, we hammer this point all the time, is that we want to stay invested for the long term. And so expanding on those ideas a little bit, our shopping list is items that we're looking into today before we actually need them. So if it's depending on what market conditions could be 12 months from now, if something is substantially different 12 months from now, we don't want to start looking 12 months from now for whatever fix or allocation we may need in our financial plans and our portfolios. We like to start looking at those things today so that we already have them and we're ready for them if we need them. And so for our shopping list of what we're looking into today, just so that we're ready with something in case we need it, is diversified sources of income. So rates have come up. I already spent time talking about how great that is for investors. We've always believed in a core fixed income allocation that invests in treasuries and invests in investment grade corporate debt. But going forward, I would say that considering the implications that credit quality can have on yield or the income that it pays and the volatility that comes with it, just looking at all available sources of income producing bonds and making sure that we're keeping an eye on the credit quality of portfolios is something that we're very much expanding our efforts on today. We've always liked dividend payers, but different forms of equity income is something that we want to keep an eye on. When we have the conversation on corporate earnings and how that translates to price today, or price in the near future, the price growth of the overall market or equities, compared to the multiple that people are willing to pay, that investors are willing to pay for those earnings. One reason that we're interested in income producing equities is that even if we see a scenario where maybe earnings fall but multiples expand, the net effect of a scenario like that would be exactly zero growth in equity markets. Same thing is that if earnings find a way to hold up, but the multiple investors are willing to pay holds up as well, that is a 0% net in equity markets. One option that we have that we could benefit in a scenario like that is income producing equities, is looking outside price return on the stock market and seeing what kind of income exists there as well. From a being intentional with our allocation to equities, large growth is dominating indices, as we talked about as well. And so we always want to be mindful of how we think, or how investors think they are allocated. What exposure do they have to large companies, mid-sized companies, small companies? What kind of exposure do they have to value, blend, or growth? And then always keeping an eye on the actual exposure to those sub-asset classes compared to what you think you may have, because large growth is dominating all of those indices. If you are in a purely passive total market portfolio, your exposure to large growth has just continued to grow over time as the prices and multiples of those companies have grown over time. And so being mindful of, having an allocation to small companies, having an allocation to attractively priced companies or value companies that have attractive multiples relative to the assets on their balance sheet, relative to their future cash flows, and then being mindful of profitable companies. Like, do they actually make money when all is said and done, or are they pre-profitable or pre-revenue companies that you're paying huge multiples for with the expectation of something occurring in the future? Be mindful of your allocation within equities. And then another component of that we like is quality. So we want positive earnings, we want stable cash flows, healthy balance sheets, consistent and growing dividends. All that to say that we don't know if or when a recession will be looming in the future. If we know that we're going to be invested in equities, we know that we're going to have exposure to everything. We do like an over allocation to things that share those characteristics. They tend to be a little bit more bulletproof as economic conditions worsen. Capturing new technologies, we talked about with the AI discussion. That very much lends to the small cap discussion as well as the last bullet point here for different alternatives and different private market solutions, where AI is going to change the landscape for a lot of things, but it's likely not going to be for the companies that exist today. So be mindful of the companies that come on the scene in the future that are in the small cap space or possibly in the private market space. And those are things that we want to consider. Looking at some slides just to back it all up from a cash position perspective, like checking accounts, savings accounts that are paying you 20 basis points, you have no business actually keeping money there outside of your operating expenses. Be mindful of your cash position, because whether it's money markets, whether it's short-term bonds, you can actually earn an income in so many things today that keeping hundreds of thousands or more in cash in the bank because it feels safe and it's good and it's not dropping in value. When CDs and money markets and 3-month U.S. Treasury bill obligations are paying you 5%, it is really difficult to justify an outsized cash position. When the Fed funds rate is greater than inflation, when the Fed stops or near stopping raising interest rates, and then when short-term rates are higher than long-term rates, all good reasons to be in bonds, to be in short-term bonds, to be in money market type investments relative to cash positions. Looking at a broadly diversified portfolio, something that we keep an eye on is, again, that kind of like that multiple evaluation that we had a long conversation about for the equity markets, of what that looks like across all markets. All of this is just measuring standard deviations from the mean for valuations for all of these asset classes. So stocks aren't the only asset that can be overpriced or that can be underpriced. Particularly bonds, whether it's treasuries, whether it's core U.S. corporates, developed market equities, anything like that, are below their historic averages in terms of valuations, which means that we want to be mindful of that they're potentially cheap. When we like to think that we buy things for a value, we pay less as opposed to more for the same set of cash flows in the future. We want to say that, hey, they're still within the bounds of normal, because that up one, down one standard deviation is still well within normal, but they're attractive relative to their historic prices. While on the flip side of things, the growth, U.S. growth, U.S. large caps are very much trading above their averages. Green dots are where we are today. The green diamonds are where we were at the end of 2021. Everything is at a lower price multiple than it was at the end of 2021, but not everything is low compared to where it has been historically. And so that's where we can really see the difference for large companies overall, growth companies overall, how overpriced relative to history they still are today. Last two things are, are for us to say, why do we want to have diversified portfolios? How do we construct our portfolios? We talk a lot about stocks. We talk a lot about bonds. We talked about cash. How and why do we determine what allocations we have in our portfolio to those asset classes? This is the range of stock, bond, and blended account total returns on rolling periods. So the far left is the average of returns over 1-year rolling periods. You can see that from a stock market perspective, they can be down 39%, they can be up 47% in any one given year. When you look intra-year, it can actually be even more than that. And so we know that if we're trying to provide an income or a distribution for a client, and we know it needs to happen 1 year from now, The stock market is very much not our place for it. Even bonds can be down 13%. Even a 50-50 blended portfolio can be down 15%. But when we have a 5-year rolling period, a 10-year rolling period, is see that those low bounds, what's the worst case scenario over a 10-year rolling period annualized for any of these asset classes? When you go from 1 year to 5 years, the worst 5-year annualized return period for stocks was 3%. And so we know that if we have an obligation 5 years and a day from now, statistically, there's a pretty good chance that we can fund that with equities out of a portfolio, but we still know that there's a little bit of that downside risk. Well, what if we are in that worst case scenario where stocks return minus 3% annualized over that time frame? We still want to make sure that we have bonds or that we have a blended portfolio for it. Same thing goes with a 10-year perspective. The worst 10 years for bonds is a 1% return with as high of a possibility as a 16% return over a 10-year period. And so when we're determining how to build a portfolio, what to have in stocks, what to have in bonds, what to have available in cash, we talk to a lot of our clients about how many years worth of income or how many years worth of portfolio distributions we have in all of these asset classes. And it's with this consideration in mind, knowing that if we're looking 20 plus years, which we are for most, if not all of our clients, the worst that the stock market has ever done annualized on a 20-year rolling perspective is 6%, and the best it's ever done is averaging 17% per year for 20 years. We really, really like our stocks for the long term. It really helps us forget years like 2022, where in the short term, we're having a bad time, we're not earning a lot of money. All of our portfolio composition comes back to this concept. And then the last part of making sure that you stay diversified, that you stay invested, this is consumer confidence and the stock market. And all of this is to say that don't let how you feel about the economy or how you feel things are going to turn out overrule how you feel about investing. Because what we see is the line chart itself is consumer sentiment. Above the blue dotted line is positive sentiment, below is negative sentiment, and the dots that we see at the inflection points are the subsequent 12-month returns for the S&P 500. And as you can see, that when investors feel particularly gloomy, they tend to sell risk assets, they tend to go to cash, they tend to give up on things, and that tends to be the exact worst time to do that, because as sentiment bottoms, returns tend to be pretty good after that. On average, 24% returns in the next 12 months after those sentiment bottoms. Again, just like with the slide before, not to say that the market is going to return 24% over the next 12 months, but it's an important reminder for staying invested for the long term, because just when things feel the worst and all of the consumers around you are, contributing to that as well, where everyone feels gloomy and they start selling off the risk assets, is generally the worst time to do so. It's important just to stay invested. So, and with that said, that's the end of our presentation for today. Jim, I imagine if we had any questions come through to this point, you would have told me, but we're very happy to stick around and answer any questions for the next couple of minutes that may come through.
Yeah, we did have a few questions. I'm going to kind of summarize them because a few were the same. If I was looking to make a major purchase in the next 2 to 3 years, where do you think is a good place for an investor to kind of park their money or invest over kind of a short-term period of time?
Yeah, so we are pushing investors towards money market funds for very short-term obligations. If there's no chance that your purchase is less than 2 years, say you need to buy something in 2 years and there's no chance that it's less than that, we are seeing good value in the CD market or those short-term treasuries or short-term corporates. The main risk that investors run with money markets, and this isn't even just for funding an obligation in 2 years, it expands to the rest of the portfolio as well. Money market funds that pay 5.2% today are really attractive, but money market funds that pay 5.2% today are subject to possibly paying 4.2% 30 days from now if rates were to substantially change. And so knowing or assuming that rates are more likely over a 12-month, over a 2-year perspective, more likely to fall than they are to rise further. Buying a CD, buying short-term bonds, buying any of those actual like time demand deposits, at least guarantees your rate for that period of time. Whereas taking a little bit more of a payment today to buy a money market runs the risk of 12 months from now it paying considerably less. And then the back, second half of your investment period, year 2, you run the risk of earning a whole lot less.
Awesome. And the last question, with the 2024 election coming up, is Aspen watching what's going on in the election news, and does that impact how we manage any of our investments?
Yeah, we keep up with the news. I will say, and I would probably next quarter, maybe the quarter after that, we do include the historic data on what impact elections have on markets in the long term, what impacts, whether it's a split Congress or an all Republican or all Democrat, everything, whatever it may be, what impact that has on markets for the long term. And for all of you who chose to attend today, I will give you the sneak preview of what that is before it airs, 2 quarters, 3 quarters from now. And it's that it has absolutely no impact on markets in the long term. It's very possible that you see short-term volatility, 1 day, 1 week, 1 month, may react to somebody who wasn't expected to be elected or a shift that wasn't expected to occur. You may see some short-term adjustments, which make it feel like it's a really big occurrence and it's a really big change in philosophy and market returns and everything like that. But really, the elections have little to no impact on long-term market returns.
All right, that's it. Thank you so much, Nathan.
Yeah, thanks, Jim. And as always, if any questions come up after the fact, all of this is still very much unique to you as individuals. Everything is still very personalized, so don't hesitate to contact us with any questions that you may have. We're always here to help.